Hey everyone, I'm Roger Herring. I am the Investors Accountant. Welcome to another edition of Ask Roger. Today's question came from Facebook, and somebody wants to know, how do I hire my kids? I love this strategy. I use this strategy to help pay for my kids' college. And if you do it right, you can do it almost completely tax-free for the child, and you get a great big deduction. Okay, so there's a few rules you have to follow. It must be your child. Now, there are strategies for grandchildren and nieces and nephews, but this isn't one of them. Okay? It must be your child. They must be under 18 in order to avoid Social Security and Medicare. And you can't pay them out of your S Corp. But of course, I have a strategy for it. You ready for it? Let's go to the whiteboard and I'll explain it all. Here we go. Okay, everyone, here's how it works. First off, under 18 and 18 and over. 18 and over is simple, so we're going to put it this way. You can pay the kid up to $13,850, and there will be no federal income tax. There may be state tax because the standard deduction at the federal level is $13,850. Your state is going to be completely different. Now, if they are over 18, you have to issue a W-2 or a 1099. And they will have to pay Social Security and Medicare. That's just the way it is. Now, you can pay them, in this case, out of any of your business entities. So if you've got an S Corp, a C Corp, a partnership, or a sole proprietorship, you can pay these kids from anything. That's if they are over 18. Now, if they're under 18, here's the thing. We don't want to pay them out of an S Corp. So no S Corp. Boom. No S Corp. We want to pay them out of a C Corp, right? Wrong. No C Corp. No C Corp. No. We want to pay them either out of a partnership where the only partners are the child's parents, mother and father, or we want to pay them from a sole proprietorship or a single member LLC where the member is their parent. If we do it from a partnership, the child is under 18 and the only partners are the child's parents. Or if we do it from a sole proprietorship or a single member LLC that is taxed as a sole proprietorship and owned by one of the child's parents, then there is no Social Security. There is no Medicare. There is no W-2. There is no 1099. As with the over 18s, you're probably going to have to pay a little bit of state tax. You can pay them up to, once again, $13,850, no federal income tax. And you get to write off this $13,850. Now, here's the deal. The kids actually have to earn the money. You can't just stroke a check and pay them. What are you going to pay them for? They can shred papers. They can push a broom. They can stuff envelopes. They might be a model for your advertising and marketing for that company. But Roger, I work out of an S Corp. So what do I do now? Here's what we do. Here's your S Corp. Okay. And you're going to set up also an LLC that is a sole proprietorship. It will have a bank account. And what you're going to do is you're going to hire the kids in the LLC.
Now the kids also, they need a bank account. The LLC needs a bank account. And now the LLC will contract with the S Corp. And it will invoice the S Corp. The S Corp will pay the LLC. And the LLC will pay that money to the kids down here. So the flow is kids do the work, LLC invoices, S Corp pays, goes into the bank account, and you pay the kids into their bank account. That's how it works. Now, on your taxes, what are you going to do? You're going to report this as a Schedule C, and you might have $10,000 worth of income, but you're also going to have salary expense of $10,000. Nets out to zero. There you go. If you've got a partnership instead of an S Corp, what you can do now, here's your partnership, and only the child's parents are the partners in the partnership. This can also be a multi-member LLC. Then you can hire the kids directly. Now, people always ask, Roger, why am I going to pay my kid $13,850? Well, so you can write it off, to be dead honest. But here's what I'm going to do. I'm going to pay the kid the full $13,850. Or in my case, with my youngest son, he worked 30 to 40 hours a week doing my social media marketing for me and doing my video editing when he was still in college. And what did he have to pay? He paid his rent, he paid his insurance, he paid his car off. What can you do with this $13,850? Well, the kids are going to want video games. The kids are going to need clothes. You can use the kids' money to buy these things. Now, let's do a smart play. I just mentioned college. Here's the deal. Because this child now has earned income, they can have a Roth IRA. This is a custodial Roth that you as the parent control. And of this $13,550, you can put $6,500 in this year. Next year, you put in the max. If you're in real estate or in some type of self-directed mode for the IRA, you can earn a lot of money with this. And when the child turns 18 and goes to college, he can withdraw tax-free, penalty-free. I have a good friend that has activated this strategy at my advice. Right now, there's over $140,000 in his son's self-directed IRA. Yeah, pretty cool, huh? Let's go away from the whiteboard and wrap up, gang.
All right, in a nutshell, this is an awesome strategy. It's not hard to implement, but you got to dot the I's and you got to cross the T's. If you do it right, you won't have to issue a W-2. You won't have to issue a 1099. The child is exempt from federal income taxes up to the first $13,850 that you pay them. There is no Social Security and Medicare. They might have some state taxes, though, because state laws are different than federal. Hope you enjoyed it. Till the next time, Roger out.